Let's get right in from the top, guys. So this article is coming from CNBC. The 30-year fixed mortgage rate just hit 8% for the first time since 2000 as Treasury yields soar. Those of you who are watching in the markets last week, the 10-year yield went and touched 5%, which the 10-year yield and 30-year fixed rate mortgages track with one another pretty consistently historically. And we saw 8% mortgage rates, guys. Now what the heck do we do?
Well, guys, how'd you feel? Were you even surprised seeing this?
I was not surprised actually seeing this. No, because, every week I'm looking at data, I'm looking at the information that's coming out, economic stuff and the releases, and you go, okay, well, if this happens and there shows any sign of strength in the economy, no matter what sector it is anymore, it's going to put more pressure on the Fed. The 10-year yield goes up, mortgage rates follow suit.
That's right. Here we go. History in the making. They always say history always repeats itself. Well, here we go. The last time we saw this was back in 2007.
Yeah, so mortgage rates rose sharply, really kind of on time. I hate to even say that word. It's really
on time, huh, Andy?
Ill-timed, but on time because it tracked really well right there with the 10-year note. But obviously, guys, this is going to spill over into there being some more psychological pressure on demand and buyer's psyche and even homeowner psyche. But we talked last week about on the show there are some solutions in the market. We'll come back to that in a minute. But I think this is really the unintended consequence of needing to raise rates on the Fed side in order to curb spending, but that spending curb is not curbing.
Yeah, it's not curbing. And as long as consumer spending keeps spending, we're going to continue to go into the higher interest rates. I wouldn't be surprised if we see the 9s, later down the line. As long as if people stop spending the money, then that's how we're going to kind of put this at ease. That's when we'll start seeing things kind of start going down. And that's some of the questions that I actually get asked from clients is, when are rates going to go down? And I tell them, have you been spending? Yes. Well, they're not going down anytime soon. So key factor here is let's not spend as much. Let's just try to be as frugal as we can during these times. So that way we don't show the Fed that we have all this money in our piggy banks where we're able to spend.
Yeah, we're not doing a good job of showing it because last week retail sales came in far higher than expected. Yeah. So, what do you guys think? What direction are we going in next week?
Well, I'm glad you brought that up, Mikey. The retail sales number came in 3 times higher than projected, which, something is awry. Either the number is some sort of false positive reading, or it is a skewed stat that is now going to then dip into the decision that the Fed has to make for what their dual mandate is. But the truth of that is spending is spending, but I think it's happening broadly by credit cards. You see credit card balance to the total of credit card balances exceeds $1 trillion just a couple months ago. We talked about that, and it's going to stay up there until people spend down their debt servicing, but they're not doing that either. So the retail sales is giving the evidence or maybe the false evidence that, everything's fine in the economy, but people are basically spending against their cards, and now we're going to have a debt problem, or in addition to a mortgage rate issue, you have a debt problem, but that leads to a solution. And I've been saying this, I'm starting to say it like this, like home equity is going to be the new ATM for the next 12, 24, maybe even 36 months. Yeah, we've seen it before, but also I really honestly think home equity is going to be the ATM machine to help people get out of some really tough times.
No, absolutely. Again, here we go, history once again being repeated. We don't know what the Fed and how transparent they're being also, and how they're counting the spending. What they're not saying is that most consumers are actually utilizing their credit cards because, like you mentioned earlier, we're over that $1 trillion mark. We've never seen that before. So how can we spend, and why is consumer spending there? Is because we continue to give credit. So maybe banks got to stop giving so much credit to the consumer so we can see the slowdown in these things.
Yeah, it's a good point. And it's a pro and a con, right? If people need to spend on the things they need to spend on, demand is demand. Like I need certain household goods and things for my house because I have got a house of people. But if I don't have the cash for it, then the consumer's only other alternative is, okay, well, put on your credit card. Well, that just delays having to pay that later with whatever future money or income you're going to get to pay that off. So, 8% mortgage rates certainly aren't a help to people who are aspiring homeowners. And to people who already own a home, it's really not that big of an issue. The broader picture, I think, is the psychological impact that's going to make on consumer sentiment and homebuyer sentiment and builder sentiment. Look, we have this inventory issue, which we need builders to show up with more homes. But if builders are hesitant because, we don't know if people people can qualify, or we have an affordability issue, well, then I can make all the homes you want. But if people can't get in and the banks can't qualify them, I can't sell those homes.
It's like double whammy.
So yeah, it's kind of like we're getting gridlocked here on a couple of different pressure points, and they're just like squeezing tighter on the left and then tighter on the right, and then from above and below. And it's like, eventually something's going to have to like give, and there's going to have to be like a relief valve of some sort, but I don't really see clearly where that is yet.
Correct. You know what I love in this article? It says, these higher rates have caused mortgage demand to plummet as applications fell nearly 7% last week from the previous week. I'm like, yeah, okay. No kidding. What are these 8s going to look like now?
Yeah.
Again, the great thing, there's still people that are purchasing. There's still people that have to purchase or sell a home. I got a client that's coming from Virginia. He's PCSing here to beautiful San Diego,
nice.
And 32nd Street. So guess what he has to do? He's like, hey, I already was a homeowner here in Virginia. I saw that I made some money. Now I want to reinvest it in San Diego because I heard it's a great market. And so the great thing about that, Andy and Mike, is that 2-1 buy down or that 3-1 buy down that we're able to, negotiate the seller to pay for our new buyer, where it makes it seem like their interest rate's much lower for the first 12 months and then the next 12 months, et cetera. We could talk about that at a later time, but there's these tools that we're able to utilize in order to make things seem more affordable.
Yeah. And that's a great point, because it does come down to a matter of perspective, because it's kind of proportionately relative based on your scenario and situation. Some people are coming to San Diego because they're PCSing here. Some are leaving San Diego because they got orders to go somewhere else. And then other times it's life situations. Yeah. Maybe someone's getting divorced and they got to sell the house, or they're getting married and they have 2 different places now that they're renting, and they're going to move into a home and they want to be homeowners when they're married. Like you're having a kid, you need more space. Like you're moving a senior into your home, or like a parent that needs care or something. There's always scenarios that are going to drive market activity, and right now that's probably going to be the bulk of what we see for the next remainder of 23 and certainly going into 2024.
You know what I like best though is when I purchased my home back in 1980, my interest rate was 9-10%. And then I actually went in there, Andy, and I went, what was the average home purchase at that time? And according to Freddie Mac,
can I guess?
Yes,
can
please. Drum roll.
1980?
Yes.
I'm going to say $30,000.
No, come on now. Go a little higher.
50.
No, man, come on now. So according to Freddie Mac, it was $112,000 average. And the average interest rate was 9.09%, more or less.
So what you're telling me is in 1980, you could have bought a house for you and your whole family for the same price as a Mercedes S-Class.
That's correct.
Wow.
Yeah. And you know what? If things continue this way, you might be just living in your S-Class.
Yeah.
No, I'm just kidding.
Yeah. You know what I should have searched, though, was what was the medium income in San Diego during that time?
Yeah. Well, guys, you know what? So you talked about, builder sentiment and how the rates are going to psychologically affect people in this market. But I think one thing people should take advantage of is the builder sentiment, because right now, they say they're using a lot of buy downs to help customers afford these homes. And that's something they would use, quote unquote, sparingly in the past. And I've seen it firsthand that, it saves a lot of people, and that could be their ticket to get into their next home.
Yeah. No, I think you're right. I think builder incentive is going to be the way to go moving forward. There are going to be builders that still want to build because that's how they make money. That's how they employ themselves. It's how they build their company, have growth, and that's how people are going to get into homes, I think. So we will see more demand in the building area, I believe. Even with elevated rates, it does not kill the fact that people want to buy homes, and we have a housing shortage to begin with. So that has to equalize at some point. I think we're going to get a relief of that in 2024, and I already see things being moved behind the scenes to try to open up some housing to people it's currently not open to, and I think that's going to help us. So
and I'm going to say back in the day, it was very common for sellers and builders to give these types of incentives to help the people. Sometimes they wouldn't give extra incentives to do any repairs. You won't know this, Mikey, because you were probably getting burped at that time. You're so young. But these things were actually in existence. So I think we're going to start seeing more of these incentive seller concessions coming, in favor for the buyer.
Yeah.